Welcome to this explainer. So, imagine this. You're diligently investing your hard-earned money for years. You're skipping the daily latte, packing your lunch, stashing cash away, only to wake up one day and discover you've lost thousands of dollars. It's literally a gut punch. And the worst part? It almost always happens because of mistakes that were entirely avoidable. Today, we're uncovering the hidden, easily avoidable errors that secretly drain wealth from beginner investors, and we're going to map out exactly how you can avoid them.
Right off the bat, let's challenge some assumptions here. Why do most beginners actually lose money? Is it just bad luck? Or maybe a lack of a crystal ball? Well, looking at decades of market data, the answer is a resounding no. The hard truth is that most beginner investors lose money because they follow terrible advice, they panic during inevitable market drops, or they just kind of dive headfirst into the deep end without truly knowing what they're doing.
To fix this, we've organized these 7 chaotic mistakes into a really clear roadmap. We're going to cover foundation and clear planning, flawed investment strategies, the psychology of investing, the hidden drain of fees, and finally, the path to success.
All right, let's jump straight into Pillar 1, foundation and clear planning, building the base before you invest.
This brings us to a massive pitfall. Honestly, probably the biggest mistake of all, just not having an actual plan. Investing without a clear goal is exactly like getting on the highway with zero destination. You're going to waste a whole lot of gas, get super frustrated, and probably end up lost. So are you blindly throwing money at stocks just because everyone else is? Or do you have a specific target? Like, are you saving for retirement, buying a house in 5 years, building long-term generational wealth, or maybe paying for your kids' education? Your investment choices absolutely have to match your specific goals and timeline. A concrete plan is literally the only thing that's going to keep you focused when the markets inevitably turn into a roller coaster.
And speaking of unpredictable roller coasters, there's a magic number you really need to know in personal finance: 3 to 6. This tackles mistake number 3. It represents the 3 to 6 months of essential living expenses that financial experts strongly, and I mean strongly, recommend having sitting totally safe in a cash emergency fund before you start throwing heavy money into the market.
And this is exactly why that math matters. Life absolutely guarantees the unexpected, right? Picture this. Your car suddenly breaks down on the way to work. A surprise medical bill shows up in the mail. Or worse, the economy shifts and you unexpectedly lose your job. If you don't have that 3 to 6 month cash buffer ready to go, you are backed into a really painful corner. You're forced to liquidate your investments just to pay for today's emergencies. And if the market happens to be down when you need that cash, oof, you're selling at a loss, completely interrupting your long-term compound growth.
Okay, moving right along to Pillar 2, flawed investment strategies. The myth of the perfect play.
One of the most exhausting mistakes beginners make is hoarding cash, just waiting for the perfect moment, or a huge crash to buy at the absolute bottom. It is incredibly stressful, and let's be real, nobody has a crystal ball. You could wait years while the market just keeps climbing. Instead, the proven method successful investors use is dollar cost averaging. That just means investing a set amount, say $500 every single month, on a consistent schedule, completely ignoring whatever the market is doing that day. It takes all the anxiety out of the equation and mathematically ensures you buy more shares when prices are cheap and fewer when they're expensive.
So, the crucial takeaway here is this classic rule. Time in the market is usually more valuable than timing the market. History shows us over and over that staying invested for the long haul is way more successful than trying to guess the unpredictable twists and turns of Wall Street.
Another huge flaw beginners make? Trying to pick that one winning lottery ticket. Like that famous tech company everyone won't stop talking about. But think about it. If that one CEO makes a terrible call, or that whole industry slumps, your entire life savings just goes up in smoke. The absolute best shield against this is diversification. It's like slicing up a pie. By spreading your money across different sectors, a slice for international stocks, a slice for real estate, a slice for tech index funds, maybe some stable bonds, you dramatically reduce your risk. If one slice shrinks, the others are right there to keep the whole portfolio balanced and growing.
That perfectly sets up Pillar 3, the psychology of investing, mind over market.
It seems like every few years, some brand new asset makes front-page news, triggering a massive collective case of FOMO, the fear of missing out. It's that overwhelming, almost physical urge to buy in after prices have already shot to the moon, usually right after your neighbor won't stop bragging about their insane returns at a weekend barbecue. You're terrified of being left behind. But always remember the golden rule of investing. If an investment sounds too good to be true, it almost certainly is.
And these hype traps, they come in so many forms.
Whether it's sudden cryptocurrency booms, viral meme stocks hyped up on social media, or, the newest AI company promising to literally change the universe by next Tuesday. It takes serious emotional discipline to ignore these flashy distractions. Instead of ditching your well-thought-out long-term strategy to go chase yesterday's hype, you got to invest based strictly on your personal financial goals and your own risk tolerance.
Because look, if you don't control those emotions, you get trapped in this disastrous, almost comical cycle. Imagine the sudden market crash. Over the span of just a few days, headlines are screaming panic and doom. So what happens? Over the next few weeks, the terrified beginner panic sells everything at a massive loss just to stop the bleeding. But then, as it literally always does historically, the market naturally recovers over the next few months. By the time that beginner finally feels safe enough to dip their toes back in years later, prices are back at all-time highs. They've done the exact opposite of the core investing rule. They bought high and sold low. Successful investors, they just stay calm, zoom out, and stick to the plan.
All right, let's look at Pillar 4, the hidden drain of fees. Death by 1,000 cuts.
Now, fees might seem totally harmless at first glance, right? A mutual fund or an advisor charging a 1% annual management fee? Sounds like pennies today. You barely even notice it. But zoom out over a few decades. Thanks to the immense power of compounding, that tiny 1% doesn't just take 1% of your final wealth, it literally eats away at the compound growth that money would have generated year after year. That seemingly innocent little fee can severely stunt your portfolio, robbing you of tens of thousands of dollars in long-term returns compared to a low-cost alternative like a simple index fund.
To make sure you're actually keeping the money your investments are earning, you've got to be absolutely ruthless about tracking these hidden costs down. Seriously, before you invest a single dollar, run through this strict checklist. Check the expense ratios of the funds you're buying, look for any hidden trading fees or commissions, scrutinize those advisory fees, and watch out for those really sneaky account maintenance charges. Hunt them down, minimize them, and keep your hard-earned cash working for you.
Which brings us to our final section. Pillar 5, the path to success. Consistent, smart decisions.
If you're listening to this explainer and realizing, I've made a few of these mistakes already, take comfort. Seriously, everyone makes them. The key is simply learning from them before they become way too expensive. You don't have to be some perfect Wall Street wizard, you just have to recognize these behavioral patterns. Small, smart decisions made consistently will completely transform your financial trajectory over time.
So, here is your definitive, foolproof sequence of actions to take today. 1. Build that 3 to 6 month emergency fund so you are never, ever forced to sell. 2. Outline a crystal clear personal goal for exactly why you are investing. 3. Diversify your assets so all your financial eggs aren't sitting in one fragile basket. And 4. Just ignore the noisy hype, avoid the stressful game of timing the market, and hold your investments for the long term.
Which leaves us with one really vital, provocative question to ask yourself right now. Do your current investment choices actually match your true long-term goals and timeline? Or are they just emotional reactions to yesterday's headlines? I really challenge you to audit your portfolio today. Hunt down those hidden fees, double-check your diversification, and take the emotion out of your strategy. Thanks so much for joining me on this explainer, and hey, here's to making those smart, consistent decisions for your financial future.